Hey, YouTubers, welcome to the Wall Street Petting Zoo, where there are bulls, there are bears, there are dead cats, there are butterflies, and we're going to get intimately familiar with all of them. We're going to pet all of the Wall Street animals. And now that I say that, I realize that sounds incredibly dirty. We're not going to get intimate with any dead cats, I promise, on this
I sure
YouTube
hope not.
channel. I'm Christopher Smith. I am a historian by training. I got a PhD, but do a little bit of trading on the side. And you are Robert Coburn.
Yeah, I'm Robert Coburn. I'm a IT manager by day, and I do investing also by day, but not as my full-time job.
Yeah, neither of us have made a professional gig of this. We're both still sort of learning, experimenting. I started in November. How long have you been trading, Robert?
So technically, my grandfather used to buy me stock when I was a kid. Like when I was starting it when I was like 5 years old, he'd buy me me and my sister. He would buy us both like 5 shares of McDonald's every birthday and Christmas.
That is so cool.
So I basically got like 10 shares of McDonald's every year from 5 to 18. And then, so that was back 2004. And then there was a few years where basically the stock just basically sat in my account. And then my grandfather cashed it out and he bought me a car with that. And then that was, years and years ago. And then when I actually started actively trading was back in 2013. I think it might have been 2012, but 2013 I started using like Fidelity and started executing trades. I did penny stocks for a little bit, and that's where I was trying to make quick cash, and then quickly learned my lesson of why you shouldn't trade penny stocks.
Yeah, penny stocks they can make you a lot of money really fast if you really, really know what you're doing and you get lucky, but they can also lose you a lot of money really fast. They're
Yeah.
definitely a risky investment.
Yeah. Luckily, though, I did make the money back. I think back in, or maybe I'm thinking dates wrong. It might have been I started investing in 2011, and then 2013 is when I made a bunch of money, and then ever since then I've just been playing with house money.
Awesome.
Yeah.
What did you make a bunch of money on?
Marijuana stocks, actually, like pot stocks. I actually was able to find a penny stock that it went up in price significantly. Like, I think I only had like a $200 investment, and I turned it into like $5,000 in less than 6 months.
Wow, that is fantastic.
Yes, but I also learned about capital gains tax after that. So that's why I learned long term is better than short term.
Yeah, that makes sense.
Yeah.
Okay, well, I was thinking that we could start by talking about some basic terminology. Some of the market words that we use, like bull and bear and dead cat.
And pig.
And pig, yes.
I like the way Jim Cramer puts the bears make money, bulls make money, and then pigs get slaughtered. So a bear is someone who's looking to make money when the market's doing not so well.
Right. A bear is a pessimist about the market, somebody who thinks the market is going to go down. A bull is an optimist about the market, somebody who thinks the market is going up. And what is a pig?
Pig is someone who gets greedy and doesn't ring the register when they should be cashing out.
Ah, see, I have almost the opposite problem. I have made some fantastic stock picks, but I tend to cash out of my winners almost as soon as I tend to cash out of my winners almost as soon as I see they're green. So I'll get, maybe 5%, and then it goes up another 45% in the next few days, and I feel like a dummy for cashing out as fast as I did. But then I hang on to losers too long, and so I think that that's I don't know that hanging on too long is my problem, but I'm sure that there are some people out there who are.
See, I do the opposite. When I see something doing terrible, I'll start reinvesting in it. Like I'll put more money into it. Like back what Warren Buffett was doing when the crash happened back in, I think it was 2008. He doubled down on like a lot of stock and ended up making way more money because the market eventually, and that's why I switched from being, you know, a bear to a bull, is because historically speaking, always the stock market will continually go up over time.
That's right. Although individual stocks, that's not necessarily the case.
True.
I recently had some Ameritrade stock, and it dropped a couple percent a day for like a couple weeks, and I ended up like 14% down. I hung on to it the whole time because I kept expecting it to turn around and go back up. And then it sort of stayed steady for a week or two, and then it started to go back up. And so I sold it once I had gained back a little bit of my money, because there was a lot of like recession fears and banking stocks weren't doing well. And so I thought, well, I should, you know, cut my losses while they're smaller, you know. And then it just kept climbing and climbing and climbing for the last couple weeks. Ameritrade is like back above where I originally bought it. So if I had hung on to it, I would be sitting pretty, you know, I would have made a profit on that trade. So yeah, this is part of my problem, is exiting winners a little too early. But
so you can't get mad for exiting winners too early as long as you make a profit. That's like, you cannot get mad at yourself for, you know, locking in a profit. Like I've cashed out way too early on a lot of things, and I have regretted it, but then I've learned, you know, I can't be mad at myself for, you know, having my money make money for me. Like I cashed out of AMD. Like AMD used to be like $2 a share, and this was not even like 3 or 4 years ago. It was like $2 a share, and I cashed out. I had like 200 shares, and I cashed out at like, I think it's $4 or $6. Like I was like, oh sweet, I'd like doubled or tripled my money. Like that's a lot of money. They're up to $30 a share right now. Like,
I know, it's amazing.
If I would have been patient and had like the patience I have now, like I'd have way more money.
Yeah, that is one of the problems, is that human psychology is not really wired for patience. We're not long-term thinkers, and so a lot of us get stuck into short-term thinking traps.
Yeah, and that's why I'm glad I read Warren Buffett's book after I started doing penny trading, or penny stocks. I learned to not be emotionally attached to my portfolio, and not always like look at it's doing bad, I should pull out right now because I'm going to lose all my money. Like I've learned to be patient and to trust the research I've put into the stocks, and to just follow the trends of the market.
Yeah. So let's talk about a couple of the different types of investing. So you mentioned penny stocks. Why don't you explain that to the listeners? So
penny stocks are essentially what they sound like. They're stocks that are stupidly cheap. Like you can get, you know, stocks for even less than a penny. Like there are some stocks that are, I think the lowest they can go on the stock market is like 0.0001 is like the cheapest. So you can essentially buy like, you know, 1,000 shares for less than $1. And the drawback to this though is obviously like the amount of volume, and the obviously if you spend like $10,000 on a penny stock and it goes broke, in other words, it goes below that 0.00001 threshold, then you're potentially just out of luck. Like you don't have any money. Versus, you know, more traditional stocks, you know, like Intel, Microsoft, banking stocks like Bank of America, Wells Fargo. Obviously, they're not going to lose their entire value overnight, pending like some sort of catastrophe. So there's less of a risk, and also there's a little bit more legalities behind penny stocks and normal stocks. Like some people refer to penny stocks as pink sheets. I don't have the actual definition of like what the pink sheets are, but it's something we can go over and like at a further date.
Sure. Yeah. One of the things that I see a lot with penny stocks is that they have the threat of being delisted from the stock indexes, and that can affect the stock price in all kinds of weird ways. They'll sometimes offer incentives for people to invest in them so that they can get above a certain price threshold in order to stay listed on the index, and that can push the stock price up. But on the other hand, if they aren't succeeding at achieving their price target, then the stock price can absolutely collapse. So these are just really volatile stocks because these smaller companies are so fragile.
High risk, but very high reward. So if you invest in the right penny stock, you can make a phenomenal amount of money in a short amount of time.
That's exactly right. It's like getting in on the ground floor of Facebook, you know? I mean, if you invest in something like a Facebook or an Amazon when they're tiny and then they become really big, you have absolutely made a fortune on a fairly small initial investment. But that's really rare.
It is rare, but at the same time, it's not, it's not uncommon enough that penny stocks don't exist for that. There are a lot of people who swear by penny stock trading.
That's exactly right. There are people who that's their strategy. A couple of the other types of investing that we've talked about, you mentioned that you're more of like a long-term trader. That's sometimes called value investing, where you look for an opportunity to buy just a really solidly financially stable company, a profitable company, at a discount. And then you hang on to it for a really long time and just watch that company grow, because usually large companies that are financially healthy are going to grow in the long term. They have the benefit of scale, and so they can sort of outcompete all of their smaller competitors. And when you've got money to invest, as long as you're putting it into research and development and coming out with new products, your company is most likely going to grow over the long term.
And also some of the bigger traders also offer interest in terms of dividends, which is nice.
That's right.
Certain stocks will offer, I've seen as high as I think 5%, some 8%, I think, for investing. So in other words, every quarter you get that amount percentage back in money, either in stock. So like if you trade with like a traditional platform like Fidelity, or Merrill Lynch, basically, instead of getting the monetary value of that stock for that dividend, you get actually like a percentage of stock, which you never really can buy individually. Like you can never buy like half a share. You can sell it, but you can't buy it, which I think is weird, or at least I don't know the entire logistics behind it. But so I've actually been doing a lot of research lately on high dividend stocks and looking at a long-term strategy for dividends-driven stocks.
Yeah, that is sort of Warren Buffett's bread and butter, is he really likes to invest in the dividend stocks. I have seen dividends as high as 20%, but those are annualized numbers. So you don't get it every quarter. You get like a quarter of that every quarter, if that makes sense.
Yeah, so about like 5% every quarter.
Yeah, right. And the ones that are 20% dividend stocks typically they're not good long-term investments, because they're like holding companies that have an investment that has a limited lifespan that's going to run out. And so they're just paying out on whatever resource they are exploiting. Like, let's say they've got oil and gas wells that are going to run out in 5 years. And so they're just paying investors out until the resource runs out, and then that stock is worthless. So you have to be really careful with the ones that are super high dividend, because I find often those are going to lose all of their value within a few years. And then with some of the more stable companies that offer smaller dividends, I find that they tend to be really volatile around the dividend time, because investors know that people are going to buy the stock ahead of the dividend in order to like harvest that dividend. And so the market actually corrects the stock price for that. And in many cases, it actually overcorrects the stock price. So leading up to the dividend, the stock price may go down. And then right after the dividend, the stock price often will like totally collapse. So if you're, a sort of a mid to short term investor, you don't probably want to buy a stock right around the time of the dividend, because the stock price is going to suffer to a degree greater than the value of the dividend. But as long as you're buying and holding over the long term, that can be a really successful stock to buy, because you're going to get sort of regular cash payouts on that stock.
And you obviously know the best time to buy it would be after the dividend. After the dividends are
exactly
announced,
right.
Because then the price will go down.
Yep. So that you can definitely take advantage of those dividend cycles, but they're a little bit unpredictable too. I actually have looked into trying to take advantage of those dividend cycles, and there are some stocks that have fairly predictable dividend patterns, and then other ones it's like a total toss-up what it's going to do around dividend time. Like, it gets really volatile around dividend time, but it's hard to tell exactly what it's going to do. So anyway, I mostly stay away from the dividend stocks, because I think that a lot of investors are looking for stocks that are companies that are going to grow in a big way. And if a company is paying out cash in the form of a dividend, then that's money that it's not investing into R&D, into coming up with new products, into doing new marketing, and expanding its operations. And so I find that over the long term, dividend stocks, the stock price tends not to get as much benefit. And I don't think that the amount of the dividend is offsetting what you're losing in terms of growth of the stock price. So I actually don't play dividend stocks, but they are safe, especially in a time of recession. A lot of people will go into a dividend stock in order to sort of escape the volatility of growth stocks during a recession.
Yeah, dividend investing is more for like passive investing, which is kind of what my bread and butter is, because I just like to, not think about it. It's a lot easier to disconnect myself emotionally from, my portfolio, because I'm not like constantly like looking at it all the time. What I've found is best is basically setting triggers for stocks that you're interested in investing in, and you basically set triggers to say, hey, if this goes below this value, send me a text, send me an email, and then I'll know at that time to go look at it, instead of, always sitting there, staring at my phone or staring at the web browsers, trying to determine, it's like, should I buy, should I sell? It helps to not be active in trading in some platforms, if you're using like Fidelity or Merrill Lynch, where every time you trade, you incur those trade fees. It helps prevent you from losing some of money on that.
Yeah, that's exactly right. I actually use alerts too, even though I'm trading on a shorter time scale. I don't sit and watch my phone all day, because you'll drive yourself crazy and you'll make mistakes if you do that. So even though I'm doing a lot of short-term day trading and swing trading, I'm still setting up alerts and getting alerts for when things happen to the stock price that I want to pay attention to. And the rest of the time, I'm doing other things. I'm working on my day job, So let's talk about passive investing. You brought that up. Passive investing is usually people are buying mutual funds or ETFs, exchange traded funds. So ETFs are mutual funds that trade on the market like a regular stock, whereas a mutual fund is a mutual fund that you pretty much only can buy at the beginning or the end of the day. And mutual funds often will have requirements where you have to hold the fund for like a month at a time. You can't buy the fund and then sell it, within 30 days. Whereas ETFs are going to not have those same kinds of restrictions. So you can buy an ETF or sell that same ETF as much as you want. So I tend to buy and sell a lot of ETFs, even for my short-term trading. But what a lot of people will do is they'll buy into either an ETF or a mutual fund that broadly holds the whole market, and then they will just hang on to that for a really long time, and that allows them to capture the gains of the market. And when you look at how traders perform on average, it's like 99% of traders are doing worse than the market on average when they're actively trading. And so passive investing allows you to get the same return as the whole market overall.
Yeah, and the beauty of ETFs too is that you can go into certain markets like the tech sector or the industrial sector and basically just capture those markets individually as well. You don't necessarily have to get like the whole broad market. And one strategy I know Jim Cramer always harps on is like if you invest your first $10,000 of investing should go into like an ETF.
Yeah. We will, in a future episode, talk about some of the different sector ETFs and which ones have historically outperformed the market, which ones are likely to outperform in the future. But let me, for right now, just keep doing some terminology. I mentioned day trading. Day trading is one thing that I do. That's where you buy a stock and then you sell it later the same day. So you're looking to capture movement within a 24-hour period and make a very quick profit on that stock. And then swing trading is where you're looking to hold a stock anywhere from like 1 day to 30 days. So it's kind of that short-ish to mid-term trade where you're looking to capture a move over like a month period.
There's also long-term and short-term trading, and that's for tax purposes. If you hold a share for longer than 12 months, it's considered long, and your interest rate is basically almost cut in half compared to like short-term trading. Correct me if I'm wrong. But it's also based on your total income as well when you're filing your taxes at the end of the year. So, what I would be taxed at would be totally different from someone who gets paid, 10 times the amount I get paid, or someone who gets paid, minimum wage. They probably get taxed a lot less than I would in terms of capital gains tax.
I actually didn't know that about short-term trading having a higher tax rate.
Oh yeah, it has a much higher tax rate. I think you're going from short-term investing. So short-term investing, that means if you buy and sell a stock within 12 months. So under the 12-month mark, if you sell a stock, usually you have to pay 50% of the money that you made, not necessarily the entire revenue. So let's say I bought stock at $50 and I sold it at $100. My net profit there is $50, and I would be taxed roughly 50% for short term. So I'd be paying $25 to Uncle Sam. Now, if I were to hold that over a year, then it would be considered long-term gains, and then that would be taxed at a rate of around 30%. And like I said, this varies based on your income. So instead of paying Uncle Sam, 25, like half your money, you're only paying him 30% of that $50. So that's what, like $15-16. So
yeah,
obviously, that's a shorter picture, but when you expand that to like how much money you could make and how much money you're investing, the more money you're obviously investing, obviously the more money that has to go to taxes. But there's a caveat to that, because if you lose money, you can actually write that off as losses on your taxes and actually recoup some of those losses that you made. So that's why you see at the end of the year stocks tend to dip more at the end of the year is because everyone's trying to just offload all their poorly performing stock. So that way, come next year when everyone's filing their taxes, they recoup some of their losses and get more money back.
Yeah. Another factor to take into account with deciding between short-term and long-term trading is it's very annoying to report investment income on your taxes, especially if you're making a lot of trades. You have to basically individually report every single trade that you made over the course of the year. And boy, is that obnoxious. So there are some of the trading platforms that will actually have automated systems that, like let's say, for instance, you're using H&R Block. H&R Block can automatically read some of the reports from Fidelity, for instance. But if you're using some of the more obscure trading platforms, you can't take advantage of that. So I use Webull, and probably the most annoying thing about Webull is that H&R Block can't automatically read its reports of all your trades. So you have to by hand input all of your individual trades at the end of the year when you report on your taxes. So that can be extremely annoying.
Yeah, especially if you're a day trader. It's very, very annoying. For the passive long-term folks, it's not that hard.
Yeah. Not that bad. Yeah, that's.
But if you use some of the major platforms like Fidelity or Merrill Lynch, they do have those integrations set with the major tax providers. Or if you have a tax professional that does it for you, that doesn't use software, that does it by hand, then they're the ones that got to do it for you. That's why you pay them. That's why you pay them the big bucks to manage your taxes at the end of the year.
Yep. Okay, Robert. Let's talk about the coming week. Do you have any thoughts about what might happen in the market this week?
Well, you did mention that the Fed is threatening to cut interest rates again.
Yeah, that's right. So interest rates lower interest rates tend to boost the market, and they also tend to weaken the dollar, and they're not good for banking stocks. Lower interest rates are not good for banking stocks, but they are good for gold. So depending what the Fed does this week, I think the market basically has already priced in the likelihood that the Fed will cut interest rates by 0.25% this week. The Fed is meeting on Tuesday and Wednesday, so they'll announce Wednesday what they're doing. And the market has also priced in that later this year, the Fed is going to probably cut interest rates again by another 0.25%. So I think that if we get a 0.25% cut this week, that may not be enough for the market to immediately go up. We also will need a signal from the Fed that it's going to cut interest rates later this year. So, let's say, for instance, the Fed doesn't cut interest rates at all, the market is going to sell off in a big way. If Powell comes out and says, no, we're not cutting interest rates at this time, we're going to see a big sell-off on Wednesday. If he comes out and says, we are going to cut interest rates right now, but we're not going to do it anymore this year, this is the last one this year, I think we still will see a sell-off. It won't be as big, but we still will see a sell-off on Wednesday. And then maybe on Thursday or Friday, the market will come back up. And then if we were to see more than a 0.25% interest rate cut, then we would see the market really pop on Wednesday. So Donald Trump has been really pushing for interest rate cuts. In fact, he's been pushing. Right now, we're at 2.25%.
He's pushing for zero.
He wants interest rates to go to zero or even go negative, because it's an election year, and he really wants to goose the economy so that he gets reelected next year. So anyway, we
fudge the numbers so you make it look really good.
Yeah, exactly. He wants to basically use up all of his political capital right now so that he gets reelected, because this is his last reelection, and so it doesn't really matter next 4 years what he does or what happens with the economy. So he wants it all right now. This is one of the problems with our short-term election cycle, is that we get stuck in some short-term thinking at the policy level as well as in the investing level. But anyway, it's going to be interesting to see what happens this week. I think that Powell is not necessarily going to cave to Trump's pressure. Powell generally has seemed to resist a lot of the pressure that he's seen coming from Trump, but he is a Republican, so he has some interest in goosing the economy ahead of an election. And he also has wanted to goose the economy in order to address inequality. Even though he's a Republican, he's really interested in taking care of inequality, and he's seen this economic expansion has been really good for low-income people. We've got, great jobs numbers, and we have seen a little bit of the wealth gap, or at least the income gap, closing. And so he wants to sustain the expansion, he has said. So we'll see what he does. There's a lot of fears of recession right now. So this is really, it's not like the economy is in a bad place. The economy doesn't really need goosing right now, but people are afraid that we're going to enter into a recession if we don't take preventative measures. So these are preventative cuts that they're making, and we'll see what Powell does.
Yeah, and it's funny because I actually read a news article, and it was about a survey results here in Silicon Valley about how some companies are actually being better prepared for a possible upcoming recession. And I myself, I've seen it. So a lot of businesses have actually been smart about it this time, where, we're kind of tightening our belts, trimming the fat and making sure that, our companies can withstand the possible upcoming recession. So a lot of people are learning from past mistakes of, the tech boom and a lot of the other bubbles that occurred, and preventing that recession from possibly happening.
In some ways we are learning, but in other ways we aren't. So if you look at debt right now, not only is the deficit, $1 trillion right now in the middle of an economic boom, which is terrifying. Like the last time that we had a recession this high was in the middle of a recession. So to have a deficit this high in the middle of an economic boom is pretty outrageous, and that could lead to big economic impacts if we do turn into a recession. The U.S.'s credit rating could get downgraded. That deficit could go to absolutely record levels, and we could see like bonds, U.S. bonds, for instance, losing their value. We could see a major weakening of the dollar. It could be bad, the national debt. And then you go and look at private debt, and private debt is even worse than it was leading up to the 2008 recession. We're actually $2 trillion above where we were leading up to the 2008 recession in terms of private debt. And it was debt that was the major driver of that recession, the fact that basically people were defaulting on their debts. They couldn't pay all the mortgages that they had gotten. This time around, it's more student debt. Student debt may be more robust against a recession because you can't default on student debt. So there's no bankruptcy. That debt doesn't get canceled if you go bankrupt. But on the other hand, when those students die, if they haven't paid their debt by the time they die, then that debt does get canceled. So this may be like a longer term problem, a debt problem, but I do think that we're going to see some major fallout from a lot of this private student debt as well, going unpaid, and that banks are going to get hurt again in the next recession.
Yeah, with all the student loan debt that's been the hot topic, in politics right now, especially with the Democrats trying to get all the voters to come to their side. It's funny how much that, with the cost of education going up so high and all this stuff, and then teachers still get paid like really poorly.
Yeah.
It's really, really just a travesty of like how the economy just doesn't. It's almost like it's not self-sustaining.
It isn't sustaining. It isn't sustainable. I mean, basically, what we're seeing is the rise of administrative costs in colleges. Almost all of the increase in the cost of college education has gone to administrators, and
bureaucrats.
Yeah, bureaucrats, exactly. And we've seen similar kinds of things happen in medicine, where basically insurers and administrators are taking most of the money, and it's led to absolutely outrageous inflation of costs. And unfortunately, I think that these are like highly regulated industries, and for good reason. I mean, we want really good quality education. We want really good quality medicine. We don't want people giving us like crappy drugs, but all of that regulation does create opportunities for big companies to use lobbying and exploit loopholes and manipulate regulation to their favor. And that is why they've been able to create these big cost bubbles. Hopefully, we will see some disruption in these industries in the coming years as new competitors enter the fields, and we've got lots of low-cost walk-in clinics popping up all over the place. CVS has just announced that it's going to open 50 health hub stores where basically you will get diagnosed by AI, and you'll get really low-cost prescriptions and stuff like that.
Seems dangerous.
I think we'll see. When they have implemented like diagnostic criteria before, they've actually seen improvements in health outcomes. Doctors have really resisted it, obviously, because doctors like to think that the human touch really adds something essential. But the AI and the sort of scripts for diagnostics have actually worked pretty well. And so, surprisingly, I think doctors, even though they're a really high-skilled labor force, I think that their jobs are going to be as much in danger from AI as, for instance, truck drivers. So we'll see what happens with that in the next sort of 10 to 20 years. I think we're going to see a lot of disruption in those industries.
I'm looking forward to it.
It's going to be a brave new world. Yeah, I mean, I'm not a truck driver, so I'm not that worried, but I know that a lot of people are going to feel the hurt once all this stuff hits with AI. Okay, well, Robert, I think that we've covered some really great basics. I think that we've given a good foundation for the show. Anything else you want to say before we call it quits for the
day? Just be smart with your money. It's especially if you're a lot older. For the younger investors, you're more easily recoverable from any mistakes, as I've made plenty of investing mistakes in the last 6 or 7 years since I've been actively trading. So it's a scary market when you're just looking at it from the outside looking in, but when you're to me it's a marathon, it's not a race. So as long as you're not necessarily putting in thousands of dollars at a time, but you can add $30 or $40 here and there, and you can eventually build your portfolio to 10,000, 20,000, and it can grow on its own as well. Make your money work for you.
Yeah, and I would go so far as to say, don't invest money that you're not willing to lose. The market is close to all-time highs right now, even though we have all these fears of recession and all these risks from the trade war with China and everything. Now may not be the ideal time to enter unless you know what you're doing. And so don't invest money that you're not willing to lose a little bit of. And also, we're going to be talking a lot more about this, but there are lots of platforms out there that will let you do paper trading and simulation of trading strategies. So if you're just getting started on stock trading, maybe instead of investing real money, what you want to do is try one of these stock trading simulators and see how you do with paper money, see how that plays out for you. If the Fed does, cut rates 0.5% later this week, I think that it will be pretty safe to put some money in the market. If we get a smaller cut than expected, then I would stay out of the market for right now and look for an opportunity down the road. So, but we are learning, me and Robert, and we hope that you guys will learn along with us. Subscribe to our YouTube channel. And we hope to hear more from you guys in the comments, and we'll see you next time that we record.
See you then.